Hey guys, TLDR Finance here. I've been getting a lot of comments on my TikTok asking me how do I get started in investing. So I thought I'd do this video today, step by step, a beginner's guide to how you can start investing. This video is going to be for absolute beginners to the stock market, so don't worry if you don't know anything about investing. I'm going to go through it with you. Did you know your money actually loses value every time you save it? If you save it over the course of 10 years, your money has decreased in value because your bank account cannot keep up with inflation, which is an average of about 2%. So unless your bank account is giving you more than 2% interest, hello? Where is this bank account? I need to sign up. Nah, but really, the market can give you way better returns. There are two main things you need to make sure you do before you start investing. The first one is making sure you have an emergency fund. This is generally 3 to 6 months worth of expenses, so that if any emergencies happen, for example, you need like house repairs or car repairs, you can pay that off without worrying that all your money is in the market. Because although the market can seem like it's consistent returns, some years it's not as pretty. You never know when the next market crash is coming. Look at the pandemic. Did people see that coming? Did investors see that coming? I think not. So you've always got to be prepared. Tip number 2, if you have any high interest debt, you should work towards paying that off first before you start investing, because the fees on that will just start building up and it's just going to drain any profits you make from the stock market, so it makes sense to pay that off first. High interest debt is things like credit card debt. If you don't pay this off, this is going to affect your credit score. You need a good credit score in life to get things like a mortgage, so that's priority before investing. So now that you've done them two things, let's get on to investing. We'll start with some basic terminology. What even is the stock market? Well, the stock market is full of public companies that allow you to buy a small piece of their company. When you invest in stocks, there's two ways you can make money from them. The first way is through capital gains. That's when a stock's share price increases over time. The other way you can make money through stocks is through something called dividends. Not all companies pay dividends. Dividends are basically the company wants to pay you for owning shares in a company. So based on how many shares you have of a company, the company will pay you a certain percentage every so often to you. So it's completely passive income. There's two main types of investor. We've got the long-term investor and the trader. So long-term investors typically invest in a stock over the long term. So they're not looking to sell for at least a couple months, years, maybe tens of years even. But the trader only does short-term trades. With trading, it's high reward but also very high risk. This is because no one can time the market. No matter how many charts you can analyze, people still cannot accurately predict the market's every move, or everyone would be millionaires, right? And it's actually that risky that about 80% of all day traders lose money compared to long-term investing. So that's why personally I chose long-term investing. It's a lot easier, it's a lot safer, and it's actually proven to produce more returns than trading. You might have heard the famous quote, "Time in the market beats timing the market." This is another reason why just long-term investing is better. The next topic I want to talk about is risk. Everyone has their own different risk tolerance. Some people would want a high reward in return for more risk. Some people would rather have a lower reward in return for a lower risk. Individual stocks are inherently more risky because that's just one stock and it could fail at any time. So what would be less risky than choosing individual stocks? There's this amazing thing called an index fund, which is actually a collection of companies. It's very unlikely that all of these companies in this index fund would fail, right? So that's a way you can minimize your risk. Another reason why they're less risky is because all these companies are generally all diversified in different sectors. One example of this is the S&P 500, which generally gets an average rate of return of 8%, which is not bad. Like, consider how much you get from your bank account. Maybe like 1% if you're lucky. This is 8%. So which one do you choose? Individual stocks that could give you a higher rate of return, or index funds such as the S&P 500? Well, it all depends on your level of risk. Index funds less risky, individual stocks more risky but a higher rate of return. Also, it depends on how active or passive you want to be. Index funds are really passive. All you have to do really is put a consistent amount of money in there every month or whenever you can. But with individual stock, you generally have to be like consistently on the ball with them of any news that might have come through that could affect the company in a bad way, possibly, because then you'd know maybe that's the time to sell. So now that you know the basics of the stock market, now we want to actually buy stocks. To buy stocks, you need a brokerage account. What brokerage account you use is completely up to you. Some have more benefits than others, and also it depends on your region. So if you live in America, some popular ones are Webull, Robinhood, TD Ameritrade, and I'll put any others I find on the screen. For Europe, there's eToro and Trading 212 and any others that I find on the screen. Personally, I'm from England. I use Trading 212. Trading 212 is the best platform for me because it doesn't have any fees at all if you stay on the Invest or ISA account. If you want to try out Trading 212, check the link in my bio for a free share up to £100. Just so you know, I will get a free share as well. If you use my link, I will love you so much. Thank you. If you're not from Europe or America, it's really easy to find a brokerage account. All you do is type in Google brokerage account in, for example, Australia, and then it should come up with a list of brokerage accounts you can sign up to. The main thing I would personally look for that a broker offers would be fractional shares. Fractional shares basically means that you can buy like 0.1 of a share of Tesla rather than buying a whole share of Tesla, because Tesla's expensive. It's like over $800 a share, you know. Maybe you only want to buy 0.1 of it. Another big factor I would look for when choosing a brokerage account is their fees. Some brokerage accounts charge you insane fees just per transaction. If you wanted to buy a stock through Halifax, for example, they charge £12.50 per transaction, whereas Trading 212 is completely free. It's a no-brainer. Do you get taxed on your profits? You do. If you choose a Trading 212 Invest account, you will get taxed on any profits above £12,300. But if you choose a stocks and shares ISA, any money that you make is completely tax-free. But the only catch is you can only deposit up to £20,000 each tax year. Personally, I am trying to max out my ISA first so that I can get the benefits there, and if I ever max it out in a tax year, then I'll go to my Invest account. But the thing is, some stocks aren't available on the ISA account, so sometimes you do have to use the Invest account. Imagine this, you have your brokerage account all set up, but now you don't know which stocks to buy. I find new stocks through either word of mouth through Discord servers or through the StockTwits app. StockTwits app is really good for finding new stocks because you can find conversation about a stock, for example Tesla, and you'll see some people talking about similar stocks. They will include their ticker to the stock, and then you can check out that stock. If it looks interesting, you can go and research it. When I'm researching a company, I like to check out their website. What problem are they solving? Why is this going to be big in the future? I normally only invest in companies that are going to be big in the future because that offers the highest potential growth, so I can potentially make more money by catching an industry early on. An example of this is electric vehicles such as Tesla, NIO, XPeng, etc. There's plenty of electric vehicle companies out there. Imagine when petrol and diesel cars get banned. All these electric companies are probably going to have huge growth because there's going to be so much more demand for their products. So the first thing I look at is what actual problem they're solving, and then the second thing I look at is their balance sheet. This doesn't matter too much though, because for example Tesla, it's running at a huge loss at the minute, but its share price is through the roof because it's based on a lot of future potential. So it doesn't matter too much, just as long as you know the company won't go bankrupt, because if a company goes bankrupt, the share price is gonna plummet probably, and you don't want that. The third main thing I look at is their competitors. What are their competitors doing? How does it compare to the company that you're researching? There's definitely more things that go into this, but I'm just going to keep it simple for you guys today. But all these things can determine how much you are willing to invest in a company, because all these things can determine how confident you are that this company will succeed in the future. You don't want to put a large amount of money in a company that you don't really believe in. The advice I would give to beginners though is, rather than picking riskier stocks such as penny stocks, you'd pick, if you want to go the individual stock route, you'd pick bigger companies such as Amazon, Facebook. These are all called blue chip companies, these massive tech companies, because it's a lower risk with these companies. It's very low risk that they're going to fail overnight. And if you don't want to do that, then you could choose a index fund such as the S&P 500, or my personal favorite is the Global Clean Energy ETF, which is the quickest growing ETF on the market right now that I can see. It's insane. That's it for today, guys. Thank you so much. I really appreciate it, and I'd appreciate it even more if you can hit the like button. Thank you so much. And also, don't forget, if you want a free share up to £100, check the link in my bio. If you have any questions, I'll be happy to help. Leave them in the comments. Thank you so much, and I'll see you next time.